The theater is full and there's a great sense of anticipation. The curtain is about to come up and all eyes are on center stage. It's about as dramatic as it gets in the economic world. On the 16th, for the first time in 83 months, the Federal Reserve Board is expected to move interest rates by a mere quarter point. Some think it's too early and that a move now will threaten a wobbly economy. Others look at looming constraints and believe that the Fed is already behind the curve. The Goldilocks gang, apparently in the majority, think that now is just the right time. Just how do U.S. inflation numbers answer that question? The Consumer Price Index, or CPI, is likely the most watched gauge of price movement in the U.S. economy. It always seems to get headlines on release day. Worry has surrounded these releases for over a year. The last time the All Items Index was at the 2% year-over-year rate, not an official target for the Fed, but at the very least an important psychological marker, was June of 2014. It tumbled steadily through the remainder of 2014, went negative in January 2015 for 4 months, and has hovered close to the zero line since. There was little change in October, and the rate for November, due out the day before the expected rate hike, will likely be higher, but not much. Taken alone, not enough evidence for such a momentous rate move. But then the Fed looks at other price movements. Food and energy prices are characteristically volatile. Strip those out of the All Items Index and you get so-called core inflation. Here, the story is very different. Year-to-year growth also saw its recent peak in mid-2014 and followed the same pattern as the All Items series. But in contrast, it bottomed out at 1.6% last December and with little interruption has been on the rise since. It climbed to 1.9% in October, just a hair below that key psychological marker. Now, despite this recent uptrend, some believe that overall prices will remain suppressed as the higher U.S. dollar weighs down import prices. We'll scan the total import price index, and you might agree, the series has actually dropped 10% from 1 year ago. However, the main decline occurred between June of 2014 and January of this year. Since then, the month-to-month movement has been more modest. That means that by the time we get into early next year, year-on-year declines will be much more like 3%. That's a pretty big shift in just 3 months. Well, it doesn't stop there. The same logic applies to commodity price movements. Plunging world oil prices mean that retail motor fuel costs across the U.S. are down 28% year-on-year. But monthly changes have been flat for a while now, and in a few months, when the big plungers are more than a year old, that double-digit decline vanishes completely. The same goes for natural gas and electricity prices, although the effects take a little bit longer to show up. These price movements might be radical, but can they really affect the bottom line? After all, motor fuel is only 5.1% of the total CPI, and electricity and gas only add 2.9% and 0.8% respectively. Well, actually, simply weighting these categories and rolling them together with other prices vaults overall CPI growth from the current negligible increase to a full 2% in just 3 months. This isn't just some theoretical back-of-the-envelope calculation. What the numbers say is that barring any further radical plunge in specific prices, all items CPI across the U.S. market will rise from nothing to 2% by January. It's simple math and it's totally predictable. But as in the past, it's likely to surprise the general public and elicit "where did this come from?" articles in the popular press. At worst, the speed of the change could spark fears of the continued upsurge in prices predicted by those who see the effects of quantitative easing as ultimately wildly inflationary. Those fears aren't justified. If these specific prices maintain their current modest trajectory, overall CPI growth will rise to the 2.2% level and stay there. That is, unless looming constraints start up a more generalized increase in the price level, still a possibility. The bottom line? Brace for a sharp increase in US CPI growth soon. But that will also be the end of it, unless it is followed by one of two things: constraints on productive capacity or animal spirits that interpret rising prices as a new era of inflation. Until next week, I'm Peter Hall.